Ever wonder what happens when Ford can't get the parts it needs to build its trucks? Well, it's more than just delayed deliveries. When supply chain disruptions hit, they hit hard, and Ford's stock often takes the biggest detour. Stick around to find out how supply chain chaos can send a shockwave through Ford's stock price. Ford, the iconic American automaker that has been around for over a century. But no matter how strong the brand is, even giants like Ford can stumble when their supply chain hits a snag. Today, we're diving into how global supply chain disruptions can turn Ford's stock price into a wild rollercoaster ride. So, what exactly happens when Ford can't get the materials and parts it needs to build its vehicles? It's more than just a manufacturing delay. It can ripple all the way from the factory floor to Wall Street. First, let's talk about the automotive supply chain. Ford relies on a vast network of suppliers to get everything from semiconductors to steel. These parts are sourced globally, from China, Mexico, the US, and beyond. This system works great, until it doesn't. If a factory in one of these countries shuts down, let's say due to a pandemic, a natural disaster, or even a labor strike, Ford suddenly has a huge problem on its hands. Without key parts, they can't build cars, and without cars, there are no sales. And it's not just about car production, it's about profitability. Ford's revenue is directly tied to how many cars they can sell. When supply chain issues choke production, Ford's stock can start to sputter. Let's look at some real-world examples. Remember the semiconductor shortage of 2021? It hit the auto industry like a ton of bricks, and Ford was no exception. Ford had to temporarily shut down several plants due to the shortage. This caused a massive production delay, leading to lower sales and, you guessed it, a drop in Ford's stock price. In just a few months, Ford's stock took a hit of over 10%, showing just how vulnerable the company is to supply chain hiccups. But it's not just about chips. During the COVID-19 pandemic, global shipping delays meant that raw materials like steel and aluminum were stuck at ports. This led to higher costs and lower margins for Ford, which investors weren't too happy about. So, why do these disruptions affect Ford's stock so much? It all comes down to investor expectations. When investors hear that Ford can't get the parts it needs, they start to worry. Fewer cars produced means lower revenue, and that can trigger a sell-off of Ford's shares. Essentially, when production halts, Wall Street starts to panic. And it's not just about missed sales. Disruptions also increase costs. For example, if Ford has to scramble to find alternative suppliers or pay higher prices for rare components, their profit margins take a hit, and lower profits mean lower stock prices. But here's where things get really interesting. Supply chain disruptions don't just affect Ford. They can ripple out and affect the entire auto industry and even global markets. When a major player like Ford can't get its cars to market, it impacts its competitors, too. If Ford's struggling with semiconductors, chances are General Motors and Toyota are facing the same issue. This can lead to an overall slowdown in the auto industry, and when entire sectors are hit, it's bad news for stock markets around the world. So, when supply chain problems hit Ford, it's like throwing a wrench into the entire economic engine. Investors know this, and that's why they react so strongly when these issues come up. Now, Ford's been around long enough to know that supply chain disruptions are inevitable. But the company isn't just sitting back, they're taking steps to adapt. In response to recent crises, Ford has been investing in vertical integration. That means they're trying to bring more parts of the supply chain in-house. For example, they're securing long-term contracts with chip manufacturers and sourcing more materials domestically to avoid relying too much on foreign suppliers. This strategy not only helps Ford weather supply chain storms but also reassures investors that the company is preparing for future challenges. If Ford can maintain production during global disruptions, its stock price is likely to remain more stable. So, why should you care about supply chain disruptions if you're watching Ford's stock? It's simple. The supply chain is the backbone of Ford's entire operation. If it breaks down, everything from production to profitability is affected, and that's when investors start to worry. By understanding the risks and how Ford is tackling them, you can make smarter decisions about when to buy or sell Ford stock. After all, the next supply chain disruption could be just around the corner. Thanks for tuning in. If you found this breakdown of Ford's supply chain and stock price helpful, don't forget to like, subscribe, and hit that notification bell for more deep dives into the world of stocks and investing. Let me know in the comments which companies you'd like to explore next. See you next time.